All right, guys and gals. This is Blake Morrow. You are listening to the Morning Edge webinar. I want to welcome you all back. And like I said, I still got a lot of stuff I want to talk about. But the next topic is really an important one to me because there are, especially those of you that found me on Twitter. Look, I get real skeptical about certain people in the markets. Most of you know who I am. I've probably met at least half of you in person, which is awesome. I over the years during our conventions, I've shook your hand. Some of you have watched me trade, like physically been in a trading room with me over the years, and you've watched me. Excuse me, I just burped. I didn't mean to do that. You've watched me trade, in front of you. You know who I am. There's a lot of people out there. I don't know who the hell they are. For all I know, they could be some kid sitting in their grandma's basement, pretending to be whoever they are. So I guess the point I'm going to try to make here is be careful who you follow, okay, and be careful of whose analysis you're following. You don't know who they are. What I do with other people's analysis, it's really interesting. I develop I watch people and I kind of learn them, okay? And this speaks for analysts too. I read a lot of I probably read a good dozen bank reports every single day. And I know what analysts I like, what analysts I don't. I know what traders on Twitter I like, the ones that I don't. I follow some traders on Twitter because I like to fade them. Yeah, I do. It's a secret list that you'll never know who they are. But there's a lot of traders out there I use for confirmation, and I respect what they do. And that's what you should do with the people that you follow. Use what information you have out there to assist you in making decisions, good or bad, buying or selling, or whatever, however you want to look at it, is when you find somebody that you trust their analysis. Don't blindly follow anybody. That's silly. Use their analysis to help confirm what you're doing. There are a lot of traders that I really truly respect out there, and if I say, if I'm thinking in my head, man, I'm buying the euro dollar today, great, and then there's a trader that I really respect that's actually shorting the euro, I'm going to stop for a moment and say, okay, well, what does that person see that I don't see? Doesn't necessarily mean it's going to alter my view, but I take it into consideration. So use other traders and their abilities to help confirm what you're doing, okay? Or maybe even make you think twice about what you're doing. There's a lot of traders out there who have really, really helped me in a positive way, who's kept me out of hot water in certain trades because I respect their analysis. I respect their specialty and what they do, and it's really helped me a lot. I know a lot of crude oil traders that they start buying crude, and I'm like, I happen to be short the Canadian, and I'm like, oh Jesus, maybe I shouldn't be short the Canadian right now. Things like that. Okay. When you trade in the markets, here's another topic I wanted to talk about. When you trade in the markets, size that you trade, it matters. It matters. It's everything when you're trading. Okay, the size. Now, it's not. The size isn't a. Oh, I'm trading. $1 million worth of currency, and you're trading $10,000 worth of currency. It's not that. It's size in relation to what you typically will do, what your comfort level is. All right. Size matters because size will help you formulate your plan to the best of your psych abilities. In other words, If you trade in a comfortable size in relationship to what your account balance is and what your risk parameters are, it'll allow you to make better decisions. If you trade in too big of size, you will make poor decisions based on money and not based on the information you have in front of you. The barometer, the risk barometer that I've always found to be the best is the sleep barometer. Can I be in a position, this position that I'm in, can I sleep better at night? Or can I sleep okay at night knowing I'm in that position? If I can, then that means I'm in a good size position. If I am in a position and I can't sleep at night, and I'm thinking about my trades, and I'm thinking about my account, and I'm thinking about how this trade is impacting my account, then I'm in too big of a position. Bottom line, all right? Everybody has different risk parameters. That's the reason why I don't talk about stop losses. I mean, I always tell you, I've got a stop, and my stop is going to be somewhere over here, but I'm not going to say I'm buying this and my stop is here, my limit's here, because that doesn't make any sense for you as a listener, because your risk parameters could be completely different than mine. I'm trading a seven-figure account, you're trading a five-figure account, our trading parameters are going to be completely different. Or if I'm trading a six-figure account, you're trading a nine-figure account, your risk parameters are going to be completely different than mine. Okay, so we talk about size in terms of comfort level. Okay. And you should figure out where that's at. I can't define that for you. It's not something that I can sit here and go, okay, all right, hey Joe, or hey Sally, this is your, you're trading a $100,000 account. You should only risk this, and you should always look for that, and your stop should always be here, and it should always be 10 pips, and it should always this and that and that. You can't do that. I can't. No one can do that for you. You have to figure that out yourself. I'll tell you where my comfort level lies. My comfort level lies always within a percent of my account. A percentage, meaning that I'm willing to risk, 0.5% in my account in this one trade or this one idea, and I'm looking to make 2% based on that risk. But that's my comfort level, and that doesn't mean it's going to translate to your comfort level. But figure it out, because the quicker you figure that out, the better off you're going to be, and the quicker you can get to business, to doing business in the market. So figure out where your risk parameters are. It's so important, because size matters. And remember, if you can sleep on it, then you're within your risk parameters. If you can't, and you're like worried about your trade, and you're like, that means you're too big relative to your account size. You should be able to sleep. Okay, I should be able to walk away from my positions and say, my stops and limits are in. Not even worried about it. I got to stop in here, and if I get stopped out, big deal. I get stopped out. It's just a bad trade, because you will have bad trades. You're going to be lucky if you're right 50% of the time. You are going to have bad trades. So just deal with it. Make sure that you have your position sizing tailored around where your comfort level is. And again, I can't figure that out for you. You and you alone can only figure that out. Now, speaking of size, you should have different ideas. Meaning, you should have different ideas of what is a good trade and what is a so-so trade. Okay, if it's like you're probably only going to have really, and I'm just going to use this on average, you're probably only going to have one or two really great ideas every month. If you're trading currencies. If you're trading stocks, you can probably find a lot more, because there's more opportunities out there. But if you're trading currencies like I do, and maybe focusing on some of the indices like maybe the S&Ps, and trade some gold, and when you have a very limited basket of assets that you're looking at, and even if you're trading equities, you still have, there's only so much you can look at one time. you're probably only going to have a handful, maybe one or two really good ideas every single month. Like I know when they come. Do you? Like when I look at the market, I say, you know what? I've been waiting for that trade all freaking month. I've been waiting for the Aussie to break down like that. That's when you go, you have to be aggressive. That's your A idea. That's your number one idea. You have to be able to press a little bit larger in size when you have a good idea like that you've been waiting for. You've been planning this trade for months. Damn it. Like shorting the US dollar Mexican peso at 21. I was short the peso overnight. I closed it for just a small gain, which I could have stayed with it. But anyway, that's neither here nor there. But you should classify your ideas into like 1, 2, or 3, A, B, or C. Okay. Obviously, you don't want to take ideas that are just, but if it's just a regular idea like, oh, hey, I wanted to short the euro when it got up to this resistance, or buy it when it dipped up to the support. Maybe that's a C idea. That's a okay. Well, I'm willing to buy a unit or sell a unit, whatever the unit is to you. And then a B idea would be like, I've been looking at this thing for a couple of days, and if it dips down to here, I've been wanting to buy that thing. And then you got that A idea or that number one idea. I've been waiting for a month for the Kiwi to break its neckline of this big head and shoulder pattern. Man, I've been waiting for this thing for literally 2 months, and here it is. It's here today. Figure out how to be a little bit more aggressive. Okay. Figure out how to, get a good entry and, manage risks to where you can be comfortable, but be in a bigger size position. All right. But classify your ideas. Is it a 1, 2, or 3, or is it an A, B, or C? And size appropriately. But always keep it within your risk parameters. What's comfortable to you. And there's a common misconception out there. In the markets. You hear it from a lot of traders. Never add to a losing position. Never add to a losing position. That's a losing strategy. I don't agree with that. I don't agree with that. I don't mind adding to a losing trade if it's pre-planned. There's a difference between pre-planned and not pre-planned. Do you understand? If I'm looking at, I'm just going to use this as an example, okay? If I'm looking at the dollar yen and I go, okay, look, I'm looking to buy this dollar yen as it approaches 116, but I'm not sure if it's going to reach 116, okay? If it gets to 116.70, I'm going to buy a little bit here. When it gets to 116.30, it's a 618, I'm going to buy a little bit more. And if it gets to this blue trend line, I'm going to buy my last piece. I'm actually buying as it's dropping. But I know that if it drops below this blue line, I'm going to get out. Look, that's pre-planned. It's premeditated. What's not okay, or that is okay in my book. It's okay as long as you pre-planned it because you've already worked it out, the risk in your mind and on paper, hopefully, that you know that, hey, if I buy it here, here, and here, and I buy one here, one here, one here, and then I get out here, my maximum loss is X, it's pre-planned because you've already managed your risk. What's not okay is buying it here, and then all of a sudden it drops to this blue line. You go, oh crap, well, we just got to this trend line, I'm going to buy it again. No, because you probably took too big of a position here in the first place, so your risk is now just proportionate. Okay? So this all goes back to what I originally said a little while ago about planning your trade. Plan your trade. It's okay to add to a losing trade as long as it's pre-planned. It's just not okay when it's not pre-planned. Okay, because now you start getting into what they call a martingale strategy, which is the worst, in my opinion, the worst strategy that will knock you out of the business faster than any other strategy out there, is when you just start adding to losing trades because it's eventually going to turn around. That type of strategy will never work. You will be out of this business quicker than you can imagine. Okay. Let's talk a little bit about risk reward, because risk reward is by far the most important aspect to this business. Because I can guarantee you this. I can guarantee you this. Without capital, you're not trading. So you better preserve it, right? If you don't have no money, you ain't no trading. Get my drift? Risk management is crucial to your success in the business. Always know your risk. Traders typically, and this is common with everybody I come across, most everybody I come across, everybody has it backwards. They go, hey Blake, what are you looking to make in this trade? Hey Blake, you bought the euro. Where are you trying to get out to make money? Where are you going to take profits? I don't even think about taking profits. I mean, I know when I look at a chart and say, all right, I'm going to buy it here. I'm risking that. That's all I'm really focused on. I'm risking that. Can I make more than that on my gain? Yes, I can make way more than that. I can make more than 2 times the good. I'll figure out what I'm going to do with that winner. But first, I need to figure out what my risk is. The reason why we figure out what our risk is first and foremost is because when you figure out what your risk is, you have it in your brain what that loss is. It's not a shocker if you take a loss, because most people, when they take a loss and they haven't pre-planned it, you get the deer in the headlights look. When you get the deer in the headlight look, when you're like getting run over by a Mack truck and you're like that deer with wide-eyed and you're about ready to get smacked by a Mack truck, the reason why that happens to you is because you haven't pre-planned your trade. If I sit here and I go, okay, and I'm just using the dollar yen because it's in front of me. If I buy the dollar yen when it drops to 116, okay, and I automatically go, okay, if I buy it at 116, my risk is at 115.80. Bam! It's already factored into my head. Look, I'm risking 20 pips right now. If I risk 20 pips right now and I buy $2 million worth of currency, I'm risking $4,000. Great. In my head, I already know I'm risking $4,000. Fantastic. So if it happens to me and I take a $4,000 loss, it's not a shocker. It's not a, oh my God, I'm a deer in the headlights. It's already in my head. It's already there. I already know, like, worst case scenario, okay, I'll lose $4,000. I can move on. Because what happens is when you have the deer in the headlight look and you take a big loss and you go, oh my God, I didn't see that coming. Now you're paralyzed. What happens when you're paralyzed? A, you're gun shy. You can't make any decisions. B, you miss every new opportunity that comes in front of your face because you're too shell-shocked that you just took a big loss. And it'll never work. Never. Risk management is so critical to your success. And you know what else is key when talking about risk management? Knowing that you're going to take losses and just take it and get out and reassess. It's okay to take a loss. There are a lot of people in the markets that I feel that are way too smart to trade. Why do I say that? I see them all the time because they know everything. They're know-it-alls. You know them know-it-alls? Like, I deal with them on Twitter all day long. I put out a chart and they're like, wow, that ain't going there because blah, 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 blah. It's like, you don't know that. But in your own head, you think you're God. And I'll tell you, when you think you're God, the market's going to show you otherwise, period, end of story. But if you think you're God, what you're going to do is you're going to try to finagle any type of trade that you get into, and you're going to try to make it work no matter what. That means most people that are too smart for the market or think they're too smart for the market have very, very poor risk management skills because they can't admit that they're wrong. Look, I'm wrong all the time. I am stupid. I am, on a Mensa scale, I'm going to be the never even made it past first base on the Mensa scale. Okay? I'm not a super intelligent person. And I'm willing to admit it. Be willing to admit that you're wrong. Be willing that you can get out, take a loss, and shake it off and move on to the next trade. Know where that risk is at all times. Make sure that your reward can outpace your risk. If I'm going to risk in this trade, if I'm going to risk 20 pips, I should be able to make at least 40. Great. Once I'm up 40 pips, I'm going to figure out how to manage it from there. But I just want to make sure I don't risk more than 20 pips because it's within my risk parameters. You can always live to fight another day. You can always live to fight another day in the markets. But if you take too big of losses, you'll not. You won't. You won't fight another day. It's too hard to dig out of those holes. So always knowing what your risk is, number one. It's key. When there are times, and this goes with risk management, there are times that you will be cold. You'll feel off. You're gonna realize, like, oh my God, you know, I've made like 3 bad decisions in a row. It's so important. It's so vitally important to realize I'm off. Let's take a step back and let's reassess. For me, it takes 1 day. Some of you will need more. For me, I literally need one. I need an overnight session. I get over things pretty quick because I'm confident in my abilities. I've been doing this for so long. It's like all I need is a day to step back and say, okay, I'm good. All right, let's get back on the horse. Some of you need more time than that. But what's important is you realize that you know, you're off and you're trading poorly. Take a step back. You know, in other words, you're digging yourself a hole. Drop the frickin' shovel, dummy. I could have used other words, but I decided not to. Drop the shovel. Take a step back. Reassess. The market's not going anywhere. Opportunities are abound. Opportunities are not going to go anywhere. There will continue to be trades that evolve and morph in front of your eyes. And one thing that I've learned is the market is always moving. Now, there are certain times, like this next week, that the opportunities are going to be a lot less. And, you know, you get in the summertime and it's a little less. And, you know, but in most markets, there's always going to be opportunities out there. So when you're cold, when you're off, drop the shovel. Take a step back. All right, and make sure. Yes, Kip.
That was me yesterday morning. I was totally off, and I knew it. I was just missing trades late. I was off, and I knew it, and I said it. I said, I'm off. And you know what? I took a little break for a little bit. I didn't make any trades for a little while. Matter of fact, when I was in the chat room after my show, I'm like, I'm not saying anything. I need to take a step back for a little bit. And I kind of regrouped myself, and then I was patient, and I waited, and I waited. And then I did actually end up finding a really great trade, and it totally made my day because of waiting for that one great trade.
Oh,
I agree with you 100%. When you know you're off, stop. So you'll just dig that hole. Keep going down the rabbit hole.
All right. Well, thanks, Kip. I'm actually gonna take just a couple minute break, go fill my coffee, and then I got a few last words before you take over. All right, guys and gals, I'll be back in a few minutes, and when I come back, I got a few last words, and then I want to take a bunch of comments before I go. So, thank you, Kip, for your input. And again, what was I saying? Oh yeah, when you're, just know when to take a step back, know when to regroup. You know when you're ready. Usually, all you have to do is take a step back and say, okay, what's that what's my trading plan. Go back to planning your trades. You know what works for you. All right, I'll be back in just a few minutes. When I come back, we will I got a few last things, and then I'm going to take some comments, so don't go anywhere. Thanks, everybody. Be right back.